Are we looking at a stock riding like a massive, unstoppable AI rally with strong buy signals? Or are everyday traders walking directly into an overvalued trap right before earnings drop?
Well, the tension surrounding that exact question right now is honestly, it's unprecedented.
Yeah,
I mean, we are 48 hours out from earnings, and the underlying data is just completely bifurcated. You have momentum indicators screaming one thing, and then fundamental valuation screaming the exact opposite.
right, which makes it fascinating. Welcome to today's deep dive. Today is Tuesday, April 21, 2026, and we are putting Nokia, ticker symbol NOK, under the microscope.
Because their Q1 2026 earnings release hits on Thursday, April 23.
Exactly. And before we jump into this absolute madness, we got to ask,
Mhm.
if you're joining us as the third person in this conversation, please like this video, subscribe to our YouTube channel, and you absolutely must leave us your comments and feedback below. We really want to know what you think.
Yeah, we read all of it. And before we really get under the hood here, I do want to establish our parameters. This deep dive is purely an educational exploration of the market data, the sources, the order flows. We are analyzing the mechanics of the market. This is absolutely not financial advice.
Totally. And the first thing we have to do is just throw our preconceived notions right out the window. Like, if you hear the name Nokia and still picture that indestructible brick phone from the early 2000s.
The one with the snake game.
Yeah, exactly, the snake phone. If that's what you're picturing, you are looking at the wrong company. What is driving this current, explosive surge in their stock price has absolutely nothing to do with consumer cell phones.
Right. It is a completely different business model now.
So let's start with the sheer velocity of this run, because the numbers over the last few months are just staggering. As of yesterday's close, which was April 20, the stock was at $10.60, and it had just tapped a brand new 52-week high of $10.69.
Which is a huge jump if you look at the floor.
Exactly. To give that some perspective, the 52-week low was all the way down at $4 flat. That means we have seen a surge of over 60% year to date.
Oh, yeah, and the trading volume is just exploding. We are looking at 88.7 million shares traded in a single session.
Which is what, almost double?
Yeah, it's nearly double its three-month average of around 46.5 million.
Okay, so when you see volume double alongside a 60% year-to-date run, you really have to ask who is on the other side of these trades.
Right. And if we look at the order flow, the bulls are definitely dominating recent sessions, but the mechanism driving it is what's really fascinating. We are seeing a massive 27% surge above typical levels in call option activity.
Wait, a 27% surge in call options right before an earnings call? I have a really hard time believing that is pure, fundamentally driven investing.
It's heavily skewed towards speculation, for sure.
Right, so I have to ask, it feels like a massive ship that suddenly strapped a rocket engine to its hull. But with call options surging like that, are we seeing genuine institutional conviction here? Or is this just retail FOMO, fear of missing out, driving the wheel?
It's a lot of retail FOMO because call options are basically leveraged bets on upward momentum. And because they're relatively cheap compared to buying the actual underlying stock, retail traders just flock to them.
Hoping for a massive payout if the stock pops on Thursday.
Exactly. But there's this secondary mechanism here that we got to talk about. When that much call option volume floods the market makers who sell those options, they have to buy the actual stock to hedge their own risks.
Oh, wow.
Yeah. So that creates a feedback loop, driving the stock price even higher, which is totally divorced from the company's actual fundamental performance.
So the stock might be going up simply because people are betting it will go up, which forces the algorithms to buy the underlying shares.
Pretty much.
If that frenzy is real, we really need to look under the hood and figure out if Nokia actually have the foundation to survive the hype. Do they actually have the cash to back up this massive pivot into AI?
Well, let's look at their balance sheet because it really tells the story of an aggressive transition. Nokia is shifting away from, traditional radio networks into what they're calling AI native infrastructure.
Okay, AI native infrastructure.
Yeah. And as of the end of 2025, their foundation is quite formidable. They're carrying total assets of $37.6 billion against total liabilities of $16.5 billion.
That's a pretty healthy ratio.
It is, but the critical number for anyone tracking their AI ambitions is the net cash. They are sitting on roughly $4 billion in liquid runway.
$4 billion in net cash,
Yeah.
and full year 2025 revenue was $19.89 billion. But here's the thing that really confuses me about this.
What's that?
They are paying a dividend yield of approximately 1.52%, which works out to about 9 cents per share.
Yeah.
Wait, let's unpack this for a second. A tech company paying a 1.52% dividend while claiming to be an AI growth stock. Usually, true AI growth companies burn through every single penny of cash they generate just to build data centers, capture market share.
Yeah, they don't usually hand cash back to shareholders.
Exactly. So does this dividend signal that Nokia is actually just a mature, slow-moving telecom trying to wear a trendy AI disguise to boost its stock price?
That is the exact identity crisis we are seeing play out right now, because a dividend usually signals maturity and slower growth.
Yeah.
It's the board of directors basically saying, we generate more cash than we know how to effectively reinvest.
Right.
But building AI infrastructure requires massive, sustained capital expenditure. So the market is looking at Nokia and trying to figure out what they really are.
Are they a steady, income-producing legacy telecom keeping their old investors happy? Or are they a high-flying AI infrastructure play?
Because they're trying to be both, the market honestly doesn't know how to price them. And you can actually see this identity crisis playing out in real time on the technical charts.
The charts are completely fighting themselves. The daily technical indicators are heavily conflicted.
Yeah, they really are. If we look at the trend followers, the moving averages, they are screaming strong buy.
Because the stock is currently trading well above both the 50-day moving average, which sits at $10.16, and the 200-day moving average, which is way down at $8.84.
Exactly. From a pure trend perspective, the momentum is undeniably bullish. And we've established strong support levels based on previous consolidation zones at 1015 and 980.
Okay, so the trend is pushing up, but the momentum indicators are telling a completely different story.
Right. The RSI, the Relative Strength Index, is flashing a major warning sign. It's sitting deep in the red zone, oscillating between 67.2 and 78.5.
And just to clarify the mechanics of that for anyone listening, the RSI measures the speed and magnitude of recent price changes. When it crosses above 70, it means the short-term buying pressure has aggressively overtaken the historical average.
It's essentially a rubber band that has been stretched incredibly tight.
Right.
It's flashing a literal sell signal, suggesting that near-term cooling is almost inevitable. You cannot keep stretching that rubber band without either a sharp snapback or, a prolonged period of sideways trading just to relieve the pressure.
And as the price pushes up, the historical resistance is thinning near $11, with further Fibonacci resistance at 11.05 and 11.88.
Right.
So imagine you're a listener holding this stock right now. If you're watching your screen, how do you handle a stock that's simultaneously a strong buy on the trend, but a sell in momentum?
It's a psychological grinder for sure. And
Yeah.
when the technicals fight each other like this, you have to look at the broader ecosystem. Like, what is the big money saying? Are the analysts buying this breakout, or are they modeling for a collapse?
Well, the Wall Street consensus is fascinating. The overall rating is a moderate buy. It's split between 9 buys, 6 holds, and 1 sell.
Okay.
But I have a massive problem with the underlying data here. The average price target from these same analysts is only $8.83.
Yeah, that is a shocking stat.
I mean, Bank of America has a high target of $13, but the low is down at $5. The stock is currently trading at $10.60, meaning it is trading nearly $2 above the average Wall Street target.
Which is wild. And furthermore, the price-to-earnings ratio, the PE, is sitting at a lofty 79.
Which, for a hardware and infrastructure company, a PE of 79 is astronomically high.
Very high.
So this screams value trap to me. You see the AI buzzwords, you see the stock going up, the call options are surging, but the fundamental valuation says it is radically overpriced.
Right, the classic value trap.
Yeah, it looks like the textbook scenario where everyday retail traders buy at the absolute top, the earnings report drops on Thursday, the hype evaporates, the stock regresses back down to that $8.83 average, and retail is just left holding the bag. Am I missing something in this valuation?
It's a totally valid concern, and honestly, it happens every single earnings season. But the counter-argument, the undervalued argument, relies on understanding how different valuation models work.
Okay, how so?
The reason that PE ratio is sitting at 79 is because PE is a backward-looking metric. It divides the current stock price by the earnings that have already happened over the last 12 months.
So it's looking in the rearview mirror.
Exactly. But if you look at the discounted cash flow models, the DCF on Yahoo Finance, those models actually suggest the shares are 4.4% undervalued relative to their future cash flows.
Oh, interesting.
Yeah, DCF attempts to estimate the value of the cash the company is going to generate in the years ahead. If Nokia's pivot into AI infrastructure works and those new revenue streams materialize, their future earnings are going to skyrocket.
And when that happens, the E in the PE ratio goes way up, and that multiple of 79 will drop dramatically, making the current price actually look cheap.
Precisely. So the algorithmic traders driving the stock up are pricing in the future AI revenue, while the analysts setting that $8.83 price target are still punishing Nokia based on their trailing earnings.
That makes perfect sense.
And there's an underlying current of systemic support that we have to acknowledge here, too. We are seeing recent U.S. congressional trades spotted in this specific sector.
Wait, really?
Yeah, while there haven't been any major 2026 insider sales at Nokia itself, politicians are buying into telecommunications infrastructure. That points to a geopolitical tailwind.
Okay, let's unpack that geopolitical angle, because that leads us directly into the ultimate bull case for this company. What does the absolute best case recovery and breakout scenario look like for Nokia?
Well, from a macro perspective, Nokia is uniquely positioned as the last man standing in Europe against Chinese telecom vendors.
Oh, right.
Over the last few years, Western nations have systematically restricted Huawei and ZTE from their critical infrastructure due to national security concerns.
Because they don't want Chinese hardware handling their secure data.
Exactly. And as countries rip out that Chinese hardware, they have to replace it with something. With some of their other European competitors struggling, Nokia basically becomes the default choice by process of elimination.
They're absorbing that massive vacuum in the market.
Yes.
And that vacuum is incredibly lucrative. The market data shows they have a projected 17% compound annual growth rate, a CAGR, for their optical networks division through 2028.
Which is huge. 17% consistent compounding growth in hardware is staggering.
It is. But why are optical networks suddenly the darling of the AI boom?
Because optical networks are the literal physical backbone that makes AI possible. We talk about artificial intelligence as if it just exists in the clouds, but it actually exists in massive, sprawling data centers.
Right, physical buildings.
Yeah, and those data centers require mind-boggling amounts of data transfer between servers to train these large language models. That data moves through data center interconnects using fiber optic cables.
And Nokia is the one building the optical equipment that pushes terabytes of data through those cables with near-zero latency.
They are building the plumbing for the AI revolution.
So it's not just the chips.
Not at all. And they recently secured a $1 billion partnership with Nvidia. Nvidia makes the chips, sure, but Nokia makes the physical infrastructure that allows those chips to talk to each other across an entire continent.
Wow.
If their upcoming Thursday earnings call reveals strong forward guidance on that Nvidia deal, a technical breakout past that historical resistance toward the $12 level is highly probable.
That is an incredibly compelling bull case. But obviously, every bull has a bear, and we need to look at the very real downside risks that could trigger a collapse, or at least a worst-case continuation lower.
Yeah, we have to talk about the risks.
The biggest threat staring Nokia in the face right now is their exposure to carrier capital expenditure, or CapEx.
This is the invisible anchor dragging on their valuation. Nokia doesn't sell directly to you and me. They sell their massive network upgrades to telecom carriers, companies like AT&T, Verizon, Vodafone.
Right. And those carriers have to spend billions of dollars in capital expenditure to upgrade their cell towers and data networks.
But those carriers usually borrow money to fund those upgrades.
Which is the core vulnerability.
Exactly. If interest rates remain high, or if there are broader economic fears, borrowing money becomes too expensive. The telecom carriers tighten their belts, they delay their network upgrades.
And the second they freeze their CapEx budgets, Nokia's revenue pipeline drops instantly.
Yep. They are entirely dependent on the spending habits of heavily indebted telecommunications companies.
And we might actually be seeing the early warning signs of that squeeze right now. The sources note that Nokia recently cut 121 jobs in Finland.
Yeah, I saw that.
Now, 121 jobs might not sound catastrophic for a massive global corporation, but it is a glaring indicator of internal cost-cutting pressures. It hints that management is trying to lean out the operation ahead of a potential revenue slowdown.
And this is exactly why retail traders so often get burned on stocks like this. They get trapped
How so?
because they trade the flashy headlines. They see Nokia partners with Nvidia for $1 billion, and they aggressively buy those call options. What they completely ignore are the boring but absolutely vital carrier capex cycles that actually dictate Nokia's downside volatility and quarterly revenues.
That makes total sense.
If the major telecoms aren't buying equipment this quarter, an Nvidia partnership signed for the future won't save Thursday's earnings report.
It makes me think of infrastructure in a completely different way.
Yeah.
It's like buying shares in a company that pays highways because you just read a headline about a revolutionary new sports car hitting the market.
Well, that's a good analogy.
It sounds like a guaranteed win, right?
Yeah.
Millions of fast cars are going to need modern roads.
Yeah.
But it falls apart the second you realize the local city councils just slashed their entire budget for paving roads.
Exactly.
The sports car might exist, and it might be incredible, but the infrastructure company isn't getting paid to lay the asphalt right now.
That analogy perfectly isolates the risk. You can have the best AI networking hardware in the world, but if the telecoms do not have the capital to upgrade their physical pipes this year, Nokia's bottom line is going to suffer in the short term.
So we have covered a massive amount of ground here, from options hedging and technical momentum to geopolitics and capex risks. Let's zoom out and synthesize this for you, the listener. What is the final outlook here? How should we frame the short-term reality versus the long-term perspective?
Short term, we are looking at an extremely high risk of volatility around the April 23 earnings call. I mean, it is a powder peg setup.
Right.
You have heavily overbought technicals colliding with incredibly high retail expectations, fueled by this whole AI narrative. Any slight miss in their forward guidance or any hint from management that global carrier spending is slowing down could trigger a sharp and immediate sell-off as those call options expire worthless.
But if we look past the noise of this week's earnings, what's the long term?
Long term, the picture fundamentally shifts. That projected 17% compound annual growth rate in optical networks is a structural advantage.
Yeah.
It paints a picture of a company quietly, steadily embedding itself into the absolute bedrock of European AI and telecommunications infrastructure. If they successfully execute that transition and maintain their geopolitical dominance as the safe Western alternative, the current price of $10.60 might look like an incredible bargain a few years down the line.
So it's the ultimate test of patience versus momentum.
It really is.
As we wrap up today's analysis, we want to remind you that none of this was financial advice, just a deep dive into some truly fascinating market data and sources. And if you found this breakdown helpful in cutting through the market noise, please like this video, subscribe to our YouTube channel, and leave your thoughts in the comments below.
Yes, definitely.
We want to know if you are Team Bull or Team Bear on this earnings call, because we read every single comment, and your feedback directly shapes our next deep dive.
It really does. The community insights often point us to angles we haven't even considered.
We've explored the technical tension, the geopolitical vacuum in Europe, the cash flow realities, and the massive risks tied to telecom spending. But with earnings dropping in just 48 hours, I won't leave you with this one lingering, provocative question to chew on.
Okay, let's hear it.
If Nokia's transition into an AI powerhouse is truly as bright and guaranteed as that billion-dollar Nvidia deal suggests, why is the average Wall Street analyst still betting this stock is worth less than $9? What fundamental flaw do they know about that the rest of the market is completely ignoring?